to now where we're looking to transform Bondora into a pan-European bank over the next 5 years. Peer-to-peer lending as a concept now is where our roots are and where kind of like our, let's say, technical core is. But when we look at, I think the culture, and the people today at Bondora, then we've built up a very strong team with prior experience in banking. The mindset that comes first, and then the license and the processes come later. It's built on a number of layers that I don't think anyone on the market actually is able to compete with in that category where we are. When we look at where our customers invest their money, then only a fraction of them actually invest their money in peer-to-peer lending platforms. The peer-to-peer lending investments actually make up like maybe 5-6% of the total portfolio. From our perspective, we defined those rules and transparency, 10 years ago, and everyone is just catching up with what was said there.
In terms of transparency at Bondora, how many assets does Bondora manage at the moment within the Go and Grow product?
So in terms of lending market demand overall, then demand is around 50 times higher than the volumes. So the number of customers you have money in Go and Grow Unlimited is larger, but in terms of capital invested, then at the moment it's 10% on Go and Grow Unlimited and 90% on Go and Grow. I think we've known that this is inevitable from quite early on, because the key people around the business really have a very long-term view about, growing the business, over the next 50 to 100 years.
Pertl, thank you very much for having me over today in your office. Thanks for the invitation. Very happy to have a discussion with you about the current state of Bondora. To start off, I want to ask you what I'm going to ask every platform on my stay. What is your current perception of Bondora, of the platform? From the inside perspective, where do you see the platform right now?
First, thank you for being here again. It's great to have you and have you visit us and meet the team and meet offices. But in terms of Bondora, we feel stronger than ever before. We've been now operating already since 2008, right? So we've been on the market for a long time. I think longer than any other similar platform. We've gone through a big transformation. When I look back from where we started out as a pure peer-to-peer lending marketplace with no risk management or process, so it was just matching to sort of investors open market to now where we're looking to transform Bondora into a pan-European bank over the next 5 years. So there's been a pretty big step forward. We're now close to 200 people, a lot of them in Estonia, but a further 40% in different countries in Europe. So we're growing well. We've been making quite interesting investments over the past year. First into new markets, a lot into technology and revamping our technology and the data stack. We're spending quite a lot of time and energy also on utilizing AI on day-to-day level. And obviously now the sort of bank license transformation or the bank transformation that we've started to undertake, which is a long journey, is something of that makes Bondora extremely interesting and strong for the future.
Interesting. The aspect of the banking license is something I would like to address towards the later stages of the interview, but we definitely come back to this. When we talk about the perception of Bondora, one thing I'm curious about, do you perceive Bondora still as a peer-to-peer platform?
Not really, no. As such, I think, as said, we have transformed from that stage. So, in essence today we actually have, within the Bondora group, we have two separate businesses, essentially. So we have a regulated consumer lender that originates loans, based on the same criteria and regulations that are applied to banks for consumer lending, with all the necessary, risk management processes, etc. And then, we have the marketplace, basically that sells some of those claims to the general public. So I think peer-to-peer lending as a concept now is where our roots are and where kind of like our, let's say, technical core is. But when we look at, I think the culture, and the people today at Bondora, then we've, especially as part of the transformation of becoming a bank, then we have, built up a very strong team with prior experience in banking as well as non-bank lending. And that is something that, like I said, Bondora is transforming into a bank. And I think that is the mindset that comes first. And then the license and the processes come later, in that sense that in order to become a bank, you need to kind of like start operating and acting and running the business, like a bank, earlier in order to actually be able to get the necessary licenses.
The question obviously derives from, a certain level of, let's say, confusion on my end, because I was often wondering in times of, let's say, last year, high inflation, increasing interest rates, you were often denying to, let's say, adjust the product of Go and Grow, let's say the interest rate, because you often said we don't see ourselves in direct competition with other platforms. But obviously from my side, despite your explanation, wouldn't you agree that your core is still the lending business? As you said, like it's the backbone of the platform. And the way you facilitate them also through retail investors, how does it differ from, the platforms that you distinguish? And then also as a consequence, who do you consider being your direct competitors in the market?
Okay, it's a good question. So, as said, maybe the answer to that question would have been considerably different 7 years ago than it is today. So first of all, Go and Grow as a product is very unique, right? So, it's built on a number of layers that I don't think anyone on the market actually is able to compete with in that category where we are, right? So first of all, as an investor, you invest in a pool of loan fractions from across Europe. And what that does, it provides, diversification and sustainable returns, right? And also on the other hand, it also provides a lot of data for us to do things. One, use it for risk management on the credit side, right? Out of the loan portfolio, but also it allows us to better understand, all the inflows, outflows of the investors and better manage, what are the liquidity requirements within Go and Grow. Now, second aspect is that, with Go and Grow, we have designed the product so that it can provide, instant liquidity. That instant liquidity is not guaranteed. However, we use the sort of highest industry standards to manage how we look at liquidity inside of Go and Grow. And as a result, we've been able to, out of the 74 months that Go and Grow has already existed, we've been able to provide instant liquidity in 70 months out of the 74. So only at the start of the COVID crisis, there were actually, you had partial payouts, which is also designed into Go and Grow so that when there is a situation where there's not enough liquidity, it doesn't just crash or run down like you would have, a traditional bank do, but there's a mechanism in place where investors start getting daily increments of the money. So, so these are, the first two pillars, and third, on top of it all, we are running that concept on now, 15 years, 16 years of experience of continuously going through different crises, to starting out with financial crisis. So, what does that make is, Go and Grow as a product is, in our opinion, in a completely different category when you look at the sort of peer-to-peer lending products, right? So obviously you can compare every different type of kind of investment opportunity on the market, and you can say that, oh, end of the day, it's only money coming in and money coming out. But on a conceptual level, the risk diversification, the stable returns, and the liquidity makes it very different than the peer-to-peer lending products, where you kind of like typically either you invest by project or you big loans, etc. So it's a different sort of mechanism, and that's why we don't really, when we look at competition, we don't benchmark against peer-to-peer lenders anymore, and that's been the case for last 5-6 years. When we look at where our customers invest their money, then only a fraction of them actually invest their money in peer-to-peer lending platforms, right? So the bulk of customers we have today, they either have their investments in obviously guaranteed deposits, some in kind of like insurance products, ETFs. Crypto is actually a meaningful part, but not huge, still around like maybe 10-15. And then you see that the peer-to-peer lending investments actually make up like maybe 5-6% of the total portfolio. So when we now go trace back to why we've actually designed the product the way we have designed it, is that we've done it not trying to compete with other peer-to-peer lenders, but we've tried to design a product that our customers actually want, and it's been successful. But it puts us into a different category than maybe some of the other platforms that you're following. And I'm not saying anything good or bad about those products, but they are different.
Sure. Now I would argue just because your investor base might come from different sources, or that don't have anything to do with traditional peer-to-peer lending, if that's the case, ultimately it's the product that defines, like, let's say, which market you're kind of operating in. And factors, as you mentioned, like liquidity, I'm sure there's offers in the market, we don't need to mention, that offer a certain liquidity, let's say, be it higher or a bit lower. The underlying assets are consumer loans. Most of the platforms operating in a not regulated environment, some do obviously. You have a regulated licensing entity in Estonia, but the platform itself is not regulated. So it's very easy to make a comparison or to put Bondora in the same box, or let's say same category as many other platforms. But we can leave this aside from now. If you want, agree to disagree, but still answer kindly. Like, who do you see then as your direct competitors right now?
So on the previous point, I think there's I think the decision on how people compare us is eventually with our customers, and the people in the market. So
I wouldn't say it's necessary. I would say it's the product, not the investors.
No, in that sense that it's the customers themselves who decide how they compare it, right? And that's what we are focused on, what our customers' needs are, not what other products that can be considered similar are doing, right? So we are 100% focused on what our customers want out of the product, and we've designed based on that. So that's where we're drawing our inspiration from. That's what we want to sort of like where we want to be successful at delivering on the expectations of our customers, and our customers expect those things that
but
are
as any other platform would do, right?
Steady. I can't comment on any other platform, right? So once again, I think we're the stable return, the high risk diversification, and the liquidity sets Bondora apart. Obviously, you may disagree, but out of that, so when we look at where our customers invest in, right, and how they compare and where do they kind of like really compare us against, is the sort of main parts of their portfolio, right, which are more traditional securities and more traditional sort of products, rather than the marketplaces.
So you're talking about stocks, funds, ETFs, or
more stable income opportunities, right? So we look at deposits, we look at term deposits, we look at sort of like ETFs, more stable income, stable sort of return products rather than volatile ones. So we see that for our customer base, stability and predictability of the returns is one key factor. So out of our customer base, the sort of like once again, the stock investor, like a traditional stock investor, active stock investor, is not a persona that's quite heavily represented. Yes, people have money in crypto, etc., in other sort of parts, but our customers are more, looking at steady income. Overall, we can't, like, because of regulatory reasons, we can't, openly compare ourselves with like bank deposits, etc. Right? Because
no deposit insurance.
Yeah, exactly. Because given there's a differences in the guarantees and different advertising rules, then we can't publicly sort of go out and compare one-on-one with deposits and certain ETFs. But when we're designing the products, so if you want to look at how we look at internally, then when we're designing the products and thinking of, okay, what value propositions actually matter and what our customers want, then these are the categories that we look at, right? And that's why I can't now like make one-on-one comparisons with any of them, because I'm just not allowed to do that.
Sure, but at the same time, I believe it's, you put yourself in a position where you just try to define your own position within the market, and as a consequence, you don't feel like to justify, okay, now how do we stack up against other peer-to-peer platforms? Because you explain like, okay, we see ourselves in a totally different environment, but at the same time, the environment you see yourself in, you can't openly, make comparisons because you don't fulfill certain criteria, as of yet at least. So I think that's a kind of also unique position you try to put yourself in, not taking away any credit from, let's say, the long track record you have and the history and the returns you delivered in the past. But at the same time, I feel like it leaves a lot of room to question why Bondora acts a certain way at times, I believe. Well, let's just continue and see. Go and Grow was mentioned now a couple of times. We can go a bit deeper into this product. Before, one question: how transparent would you consider the Bondora business to be?
I mean, when we look at the information we publish and is available, then Bondora was the first platform I know in continental Europe that actually made its sort of data stack publicly available. Both as on download as through APIs. We were also the first one who actually opened up the API, kind of trading and investment. And those cornerstones are still there, from, I think we did it in 2014 or 2016. So we've been, open from day one. When we, not almost from day one, for the past 10 years. So I don't really see that there's anything more we can do. Obviously, we also publish like blog posts, etc. But these are already more sort of like smaller overview pieces that are more relevant to our customer base. But at the same time, all the sort of underlying data is there. There's also, besides Go and Grow, there's the ability to invest over the API. So if you have like programming skills, and I know at one point of the time people had different sort of like, tools available that they were sharing or selling for other investors that allowed them to sort of utilize the API. But that level of transparency and sort of like access to data and access to sort of granular bidding is something that is still quite unique. But I think quite a lot of players have tried to mimic it. But when you look at the underlying data, then I don't think that all the underlying data is as detailed and transparent as it is with Bondora, because with a number of places where you can actually download the data, the information that's available through the investors doesn't reflect actual underlying loans. But that is, once again, something I'm not going to go super deep about in which platforms, but there's a lot of platforms that have created, like, taken a loan and then transformed it into something else. So the information that the customer sees about those loan claims, like, okay, this is like 10%, this is 11%, actually has no relation to what is the underlying loan that may be issued in Georgia with 70% interest rates, right? So, I think overall, in general in the market, Bondora has defined the transparency rules, right? And there's a number of great players in the market who are matching it, right? And then there's a lot that maybe seemingly have a lot of visibility, but if you actually dig into the numbers and then you look at, okay, what are the actual originations behind, then isn't the case. But once again, like, we don't really try to compare ourselves platform by platform like that. We don't see that this segment is where we're really competing in, but just from our perspective, we defined those rules and transparency 10 years ago, and everyone is just catching up with what was said there, and a lot of players have done a great job of catching up of what was the sort of maybe standard we defined a while ago, but for us it's just important to maintain this part open and publicly, but it's the public posts are more than tuned to what on the level of granularity that we think that the general customers are interested in. But still, everything is still open.
I'm surprised you didn't mention the annual reports, which is also not very common, at least in the peer-to-peer space, which are audited on a regular basis by, I think, Bondora's KPMG. So that's a very good reporting standard. In terms of transparency at Bondora, Go and Grow having a switch now. Obviously, the question: how many assets does Bondora manage at the moment within the Go and Grow product?
So first of all, Bondora doesn't manage assets, so we're not a fund, nor Go and Grow is a fund. So given, this is not a fund nor a deposit product, then we have a number of regulatory rules that apply to our marketing and communication, which in essence state that whatever we do and communicate, we cannot in any way portray the products as if they're like a fund or as if they're a deposit product. And we do a lot of work to make sure we don't, break those sort of guidelines, because, and that is something that in some parts forces us to be more round with words than we can actually, in an ideal situation be. So when it comes to detailed numbers about, okay, what is the total amount of money invested, exactly by investors and etc., then, there's no Go and Grow fund as such, right? There's no Go and Grow balance sheet that we manage. And therefore, given we're not a fund, we cannot actually imply and state and publish numbers that would, somehow portray Bondora differently than the actual product is.
I'm not sure how you go against certain regulatory laws by pointing out the assets you have under management from the company. I mean, there's Estonian platforms as well in the peer-to-peer space. Let's name Income Marketplace, that also publicly share the development of their assets they have under management. So how does it differ for Bondora having the same jurisdiction?
So when you look at the data we publish, then everything we publish under the sort of like granular loan book and the overview we provide is everything we can actually publish, right? So we don't know what are the exact jurisdictions or rules that other competitors are following, but we have quite strict rules internally defined based on the laws we know apply to us and the laws that we are destined not to sort of in any way kind of break, that set and define how we communicate about Go and Grow and what we communicate about that. It's also the words we used and etc. So it's quite technical. I cannot comment what are the things that other lenders follow, because it depends on what discussions they've had with their regulators and everything around that.
So once again, just to confirm, it's not an internal policy; it's external rules. So but you're not regulated by an Estonian entity, are you? So aside from your lender in Estonia.
So basically, in order not to fall under the constructs, given Go and Grow is not a fund, Go and Grow is not a guaranteed deposit, then you have a lot of rules that are coming from those regulations that basically define what wording you can use, what communication you can use if you're that or that type of entity, which means that if you're not, right, then you need to make sure that you're not using any communication that would imply for a retail customer that this is now a fund product or this is now a deposit product. we've done a lot of surveys among our customer base and have ensured that, all our customers understand that this is not a fund product and this is not a guaranteed deposit and the capital is at risk. Meaning that whilst we've been able to deliver 6.75% return for the last 6 years, and we have very strong internal sort of mechanisms and stress testing and forecasting in place that allow us to sort of predict, 10 years into the future and adjust our policies, today to the level that is necessary to ensure that we can deliver the target return also 10 years into the future, then we cannot in any case imply that the return is guaranteed. We cannot in any way seemingly imply that it's somehow to do with a deposit product or any other regulated product. So, as you said, so that the kind of the positioning and the setup of Go and Grow gives us certain, limits as such, right? That we need to follow. And, in that sense, they're internally defined, within compliance to make sure that we don't, have problems when it comes to sort of any rules on advertising of securities, deposits, and other regulated funds. So it's quite complex, set of rules. I don't know if and what rules are applied to the different platforms that you're mentioning and how much they have actually looked into this. But we've been in this business now for since 2008, right? We've had a lot of conversations with different regulators across all of Europe and also beyond, and it's quite, let's say, hard, and hard work to maintain a strong understanding of what you need to do in order to sort of really operate. And as you get bigger, then those rules get tougher. As a very small startup, then people don't maybe really care. But being in this business for that long of time, and we've had a lot of those conversations, and there's a lot of rules that we need to comply with, right?
Okay.
It also applies, for example, in our consumer lending businesses, that a number of the things that we today have to follow are things that are applied to banks, and rules that weren't applied to us, maybe 2016 or 17. So there's two trends, right now in Europe. First of all, regulations are getting stricter on anything related to financial services. And second part is that, more and more of the rules that, in some cases used to be applied only to banks are now applied to sort of non-banks as well.
I'm just personally confused why this would be, I don't know the specific rules that or the compliance that applies in this case that would prevent you from stating those numbers publicly. But even then, I would just boldly assume the way you have disclaimers for interest or the interest is not guaranteed for Go and Grow. The return is not returned. Yeah, exactly. Thanks. The return is not guaranteed or capital is at risk. That why wouldn't you just put in a disclaimer saying this is the assets we manage at the moment within this product with a disclaimer. We hereby, acknowledge this is not a fund actually that we're having. Yeah. This is just for transparency purpose for our investor base to have a better understanding about, the product and then ultimately also the risk profile of the product. So that would be my logic.
Look, I mean, all the things we today publish are based on, what we've gotten back from our customers that, the information at the level of granularity that's needed. At the same time, the loan data tape is 100% public, right? So anyone who has a lot of deep interest into this actually can get quite granular data from there. So I think we've kind of covered it in both sides, and right now we have not seen a need to sort of adjust. I think the strong data tape is there to support any very detailed request without us having to sort of add anything on top to the day-to-day customer.
With the logic behind the assets under management, is it the same one that applies for not publishing data on the current net return of the Go and Grow loan portfolio?
Yes, because Go and Grow, it applies to all of those levels basically, right? So Go and Grow, net return is, just to kind of talk about the design of Go and Grow again. So Go and Grow it's designed so that, all excess return, effectively over 6.75%, kind of is held back as reserves, right? To cushion continuously through times where, as actually returns go up and down. So historically, we've been able to deliver 6.75% over the past 6 years. And what we do internally is that we, as I mentioned before, we have different sort of risk management processes in place to forecast the future of those portfolios, 10 years into the future. And then we see, okay, if and what do we need to change today in either pricing, risk levels, recoveries, etc., in the operational business to ensure that Go and Grow return can be sustainable, right? Once again, we cannot say it's guaranteed, but it can be sustainable, throughout the term. So whilst we cannot state that the return is guaranteed in any way, then internally we're doing everything, humanly and technically possible to ensure that, not only in the 6 years past up until now, but also into the, long future we have ahead of us, we're able to deliver that. There's a lot of investment going into that, but the sort of like technical disclosures around these things we're not going to make about exactly how we do it on a daily level and everything that goes into sort of the on the inputs. So it applies on the also to sort of like in terms of like liquidity, for example, right? So when we look at sort of like liquidity inside of Go and Grow, then we use the principles applied in the industry to other similar institutions, right? And then based on these, we have designed the way how constantly we look at, the liquidity inside Go and Grow. And, given we've from already almost day one, I think, applied those principles, we've been able to deliver instant liquidity, although it's not guaranteed, in 70 months out of 74, which is our great achievement.
Well, let's stick to the return 1 second, because still on the, let's say, general statistics page on Bondora, we can see there's a net return pointed out with 6.4% at the moment. Is this all loans from
2009?
And this implies so the assets that went into Portfolio Pro, Portfolio Manager.
It implies everything, yeah. It implies
including Go and Grow?
It implies all loans. It implies all loans. So it implies all loans that we've issued ever throughout Go and Grow, not only from Go and Grow, but individual investments, APIs, Portfolio Manager, Portfolio Pro, every single country. It also implies, sort of like institutional investors that we used to work with who kind of buy specific blocks of loans. It's basically all loans.
All right. Obviously, then the question is, how sustainable do you think the return of 6.75% is when over the span of 16 years your general performance is below that mark?
So, as said, the return that's there is calculated over 16 years, right? And we started Bondora, Go and Grow 6 years ago, I think. And, a bulk of the activity in Go and Grow and investors have, basically, invested in the past years. So when we look at also when we started versus where we are now, then we by now have invested, into hundreds of thousands of loans that continuously allow us to fine-tune the credit models, fine-tune the way we price, to fine-tune our operations. So, as every day goes past, the higher, we can get the margin, on the loans that we issue. However, of course, when we talk about the margin, on each loan issued, then there's also the factor of, okay, what is competition doing, because you need to price the sort of loans from the consumer borrower's perspective as well competitively. But as we get better at understanding the risk levels and everything around that, we can always make sure that every loan we book has the necessary sort of like margin to deliver the 6.75% to investors. And I said, we feel quite confident, but we do a lot of work on risk management side on ensuring that we're able to do that sustainably 10 years into the future, right? So we're not looking at like some short period of time, but we're actually simulating 10 years into the future on understanding, okay, if and what we need to do today, to ensure that the returns that we want to deliver to the Go and Grow customers are sustainable for that timeline.
Obviously, I see it a bit twisted because on one side, Bondora itself as a company seems very, let's say, financially stable, but at the same time, those indicators bring up or lead to a feeling of, okay, Bondora apparently has certain struggles if you look at the statistics when it comes to the performance of the loan portfolio. Seeing also having a lot of investors that had negative returns in the past, and then how to trust a product like Bondora Go and Grow, which in a nutshell is a black box, very hard to understand from the outside in terms of how many assets are actually underlying there. You sub-communicate a few numbers, 100,000 of loans and here and there, but what is the actual return? How big is that liquidity buffer in the end? As you mentioned, is also something you can't properly comment on to understand, like at which point might investors run into the risk of partial payouts again, or because you're selling this product very much on liquidity, but not having an understanding about how the actual underlying assets are performing makes it very difficult to understand for investors how much they can trust this product outside of just arguments. Okay, there's a long track record and you delivered reliable most of the times in the past. So how do you want to deal with this situation, or do you believe like many investors are not that concerned about it at all?
No, I mean, when we survey our customers, then almost everyone always comes back that they understand that their capital is at risk at Bondora. They don't look at this as like some kind of a guaranteed deposit. So when we look at what our investors understand, that yes, they understand there's risk involved with Bondora, right? So obviously, I'm not sure if they're concerned or not concerned, but they're diligent that there's investments risks associated, right? But the stable net return and the liquidity they've been able to access is a very strong value proposition compared to many other alternatives on the market, right? So now looking at if you say that okay, we've been able to deliver 6.4% annualized return over 16 years, then if you look at even traditional products also in terms of stocks and bonds, etc., then through that 5 crises, it's actually a very strong return. Now obviously when we look at Go and Grow today, then our target return is 6.75%, which means that we are constantly investing and have done so for many years now into risk management, into pricing, and into the sort of credit collections and all of those operations that are necessary to be able to deliver that return to investors, right? So, the loan portfolios today are diversified across many markets. Estonia and Finland, we've been operating for many years, and these make up the bulk. Netherlands is growing quite steadily, but as it's a new country, we're also sort of constantly every week basically looking at the risk indicators and adjusting for it. Latvia we just launched, but Latvia will scale up only next year, because once again we're gonna take it much more slowly than we did in the past, right? Because if we look at in the past, then when new markets came online, we kind of like scaled them much faster. Now we have a very kind of like slow growth profile there. So we have that part, plus we've invested now, I think the risk team is 30-40 people today that daily deal with all aspects of the sort of credit risk, from pricing the loans, from how we issue. I mean, I think you wanted to go through the process as well later on. So I've taken our sort of credit policy with me, how we issue the loans, how we price the loans, how we collect the loans, how we go to court. We have very strong today processes in each country in place. How do we take cases to court? So we've invested a lot of money, and we continue to invest a lot of money into credit risk management and pricing and everything related to that, to be able to deliver 6.75%. Of course, internally, in order to do that, we are aiming for much higher IRRs on the underlying loans to be able to deliver that, right? And those higher IRRs are not sort of that, the interest rates are higher, but actually the net return targets are higher, so that the risk buffer is strong enough. So I think the track record we have, plus the principles and policies we have in place today, and also actually the data to support it, is a very strong foundation for customers to believe that we're able to deliver on our promises. And I can just rest assured say that whilst we cannot guarantee even the principle as such, then internally we're doing everything humanly and technically possible to not only guarantee, or not, I can't say guarantee, but not only to sort of ensure that we're able to sort of safeguard the principle, but we're there to safeguard the return as well. And all of our processes and policies and the sort of internal tools we built are designed to be able to do that looking 10 years into the future.
I have a practical question. Now lately in March you had like a birthday campaign where it was allowed to deposit a couple more funds on Bondora and Bondora Go and Grow in particular. Now you attracted 31 million of funds. At the same time, I think it was March, April, you just you were able to facilitate around 15 million of euros in your lending markets. So first question here, how satisfied are you generally now with the demand from the lending markets that you operate in?
You mean from the borrowers?
Yes.
So in terms of lending market demand overall, then demand is around 50 times higher than the volume. So the volume of loan applications we process each month is quite significant, but only a few percentage points of this volume is actually what we book, and this is because of all the risk rules and the sort of return targets we've set ourselves.
Okay, understood.
So Estonia and Finland are still the biggest markets. Netherlands is growing quite well. The risk indicators are super well, there now. Latvia, we're going to continue relatively small volumes throughout the next 12 months or so, or slowly growing volumes. And then we're looking to also bring in 3 new countries over the next 18 months, and still considering, regarding Spain. So I don't think that demand is an issue, but it's more, we're very diligent to make sure that we're able to guarantee, the returns, and therefore, we need to make sure that all the loans we book actually match our risk appetite, match our return appetite as well, right? Now, as part of, I'll walk you through the entire process of how we underwrite. So there's actually quite a number of steps, in between what we need to do.
Separate event.
Yeah.
Separate interview. All right, thanks for the answer. That's interesting to hear also the ratio you have from the supply you get from borrowers and then the actual acceptance rate. So that's factor of 50 is quite impressive. Now, how do you balance attracting new funds? Obviously within Go and Grow that you can't facilitate at this point in time, but yet you're still obliged, to pay 6.75% interest return. How do you balance with funds that are not in use actually, yet you need to pay something back to investors?
Sure. I mean, when we look at the targets we've set when we issue loans, when we look at what is the sort of part of the return that is needed to be able to deliver on the promises or the targets we've set for Go and Grow, then internally we are actually looking at higher return targets. That also accounts for that there is a certain amount of capital that's basically being just sitting, so that is accounted into pricing already. So when we issue loan, we already account for the fact that there's a certain liquidity level that we need to maintain. And the level of liquidity level we need to maintain, we've designed this based on sort of rules that are applied to similar traditional products. So how much liquidity and how we look at the inflows, outflows, and everything around that. And those things basically determine, if are more active or less active with investor engagement. Now, given we're now, operated the product for 6 years and there's a lot of investors, then we have also quite a lot of statistics around investors. So we're quite well able to predict also what level of activity or downscaling our activity and engagement is necessary to maintain a balance. But with overall with every business, you kind of need to balance your inventory and your sales and sort of the suppliers. So it's in some cases, I don't want to simplify, it's no different than a restaurant would need to do, right? In our case, there's just a lot of data and mathematics that goes into understanding, okay, what is it that we now need to do? How much do we need to accelerate in terms of investor engagement? Okay, now we need to, pull back. So you also can see this from somewhat our activity levels of our engagement with different parties. So whilst in one side we would like to be constantly on, then that would create the situation that sort of the underlying loans need to deliver higher and higher and higher return to cover for the part of the funds that are in cash and that belong to the investors.
Can you talk about how Go and Grow stacks up against Go and Grow Unlimited? So how many users are utilizing each, let's say, return level? How do they compare both with each other? So,
overall, the main difference between Go and Grow Go Unlimited today is that, within Go and Grow Unlimited, there's no amount that you can invest per month, but therefore the return is capped not at 6.75% but at 4%, right? And since some time ago now, we've kind of in terms of user experience, combined those products so that the customers don't have to move the money around here and there, so they can send effectively a larger amount to Bondora, and then each month we actually take the part that's allowed to invest into Go and Grow. We take it from Go and Grow Unlimited. So if you have two products, then they actually act as one, right? So we constantly automatically balance to make sure that your money is not sitting at the 4% return if it could be earning money at the 6.75% return. And I believe that this level is something that a lot of also traditional investment products don't offer, that we actually upgrade the return on our customers on our own each month, to deliver them a better experience. And that's basically sort of the main difference. So now around 10%, so the number of customers you have money in Go and Grow Unlimited is larger, but in terms of let's say capital invested, then at the moment it's 10% on Go and Grow Unlimited and 90% on Go and Grow. But it kind of shifts every month because you have inflows. Some of the inflows first land in Go and Grow Unlimited, and then at the end of the month we kind of rebalance constantly. Because there's broadly two types of investors we're seeing. So ones are that actually making you can see kind of they've set up more or less a recurring payment each month. More or less the money comes more or less the same amount, more or less in the same day each month. And then you have people who make a bigger investment.
One-time investment.
Kind of one-time investment, or once every year, or a few times at different parts when they have a liquidity event. I don't know, they've gotten a bonus or something like that. So these are the two different types. So for the ones who make one big investment, so the money would first flow into Go and Grow Unlimited, and the 1,000 euros goes to Go and Grow, and then each month the money is moved from one another. So effectively, as we have designed the product so that it automatically gives the benefit to the investors by moving money from one tier to another when they're eligible, then you would have a situation that there's a constant growth on the Go and Grow tier, and more money constantly flowing from Go and Grow Unlimited to Go and Grow, because this is how we've just designed it. But for those investors making large amounts, once every now and then, these are typically the money that goes through there.
Sure. But understanding like roughly 10% of the capital is deployed to Unlimited, and that's a good idea, I think, for investors to understand like how they both stack up against each other. I wanted to have a couple questions about the growth. You mentioned 3 new markets within the next 18 months. Now, in the past, we heard similar, let's say, plans and ideas from Bondora, which I think you were sometimes a little bit behind. Another thing was, I remember a Q&A session of yours 2 years ago, pretty much 2 years ago, where you said like within a very short period of time you want to have 1 million of active customers. And I think throughout the last 2 years, I think the net gain was around 40,000 new investors, which is also not too bad, but obviously it's far off from what your ambition was at the time. Why do you think Bondora, let's say, failed at attracting investors at a larger scale in a faster pace than you anticipated?
So first of all, when we look at our targets we've set for customers overall, then we look at all borrowers and investors together.
Okay, you want include.
So we look at everyone in Bondora as a customer. So that sort of like puts that aside a bit.
So you managed to have 1 million customers, including borrowers?
No. There was a target at one moment. We don't kind of like keep this as a flag anymore, simply because the number of customer growth is not the best sort of North Star we have, to date. So we've decided to slightly look at business from a different angle. So we've internally not following that target anymore. However, getting to 1 million customers is a kind of, let's say, an output of the plans we have anyway, right? But it's not a target on its own anymore, which was the case maybe 2 or 3 years ago. So we've got to like, as I said, as we're gonna like maturing and transforming into a bank, the way we look at the business and the way we look at how to grow the business is constantly changing as well. So, when we're looking at the business today, then, we are, really focused on kind of like really increasing the sort of like the size of the performing loan portfolio. And in order to do that, then you basically have, let's say broadly 3 levers. One is that you lend more in the existing countries, right? Be more active, get a bigger market share. Second is that you add new geographies, and then the third is that you're gonna like expand your share of the wallet within those existing countries, but through new products. And today, when we look at our growth, then we are today focused predominantly on the first 2 levers, so which is increasing our market share in the existing countries with the existing products, and then launching new countries. Evidently, at one stage there may be a case where we look at are there any alternative credit products that we want to go into. We have a couple of products that are in sort of like let's say MVP or pilot phase for already some time. But we're not scaling them. We're still focusing predominantly on the core product and making the core product experience, much better for the underlying consumers, both on the investor side as well as, when we look at the credit business. But the new geographies is going to be, I think, strong foundation part for near-term growth. If you look at now in the past, 18 months, then we've launched Netherlands and Latvia. Which is, when we look at long-term history, then I think the last market we launched before Netherlands was in 2014. So we had a long pause in between. And obviously during that long pause in between, we changed the business completely, right? Because in 2014, 15, 16, and these are all the periods that are also sort of like when you look at the statistics, then, we we still had kind of this purely like a market maker approach, and we started to change this approach somewhere in 2016, and that meant that we needed to kind of like better invest in the infrastructure in both in terms of the technology as well as with the talent we have to be able to run the business across Europe. Now having launched 2 countries in 18 months, we're working on another 3, which will roll out in the next 18 months as well. And then, we'll see if the scope of the markets is already big enough that we can kind of slow down in terms of adding geographies. But the main reason why we're, quite strongly, investing in this area is that, having now the experience we've gained over this 16 years, we see that, to launch new countries successfully, and successfully not like, tick in a box, we have like done it, but successfully in terms of that to make it, profitable, for everyone involved, you actually need to go slow, right? Unless you acquire someone, but this is not the strategy we're taking right now. So we're not looking at M&A activities. So rather we're looking at organic growth, and therefore we have a, stage sort of scaling plan where we're very slowly, like, I think in the first month, the target is like 25 loans and something like that, where we're slowly picking up, right? And that's quite, I think, thematically different than the approach we had, 2013, 2014 when we launched in Finland and Spain.
Okay, yeah. Elaborate answer on the customer base now. So if we reduce it, let's say from the target you had back then with 1 million customers to the investor base you have right now, 225, 230, something like this, 30,000. Just a quick question, if you have that number top of your head, how many of those are active investors in the moment, if we define it as, have made investments in the last 6 or 12 months?
I don't have it at hand.
Okay.
It really typically like fluctuates. One reason is that, the type of the product Go and Grow is, it allows you to be quite steady. Like, there's some people who just put money in and then they're investing for the next 5, 6, 10 years, right? So there's another lot of like active movement. And once again, there's other people that put money on a continuous level.
All right. Then let's switch to Portfolio Pro and Portfolio Manager. If it's still in your head, I know it's been discontinued for a long time. It was, I think, Q1, Q2 last year when you stopped issuing new loans for those products. Back then, the let's say underlying communication was there's a lack of demand for both products. I would like to challenge this this argumentation that you had back in the day by saying there was events in the past where it's also like I had an interview with Matt when he was still with Bondora. That was towards the end of 2020. And he said you adjusted a bit the logic of how you attribute new loans, and you do it more looking at where's the active customer base at the moment. So if there's more users at Go and Grow, you obviously facilitate more loans for this product respectively. And this led to a change or to a transition where more of 90% of new loans have been issued for Go and Grow then as a consequence, which ultimately had the few investors that were fond of using Portfolio Manager or Portfolio Pro to face cash drag issues, dropping out from the product because there was no use for them anymore. So in a way you kind of like facilitated this lack of demand in a slightly different way to only focus now on the Go and Grow main product line. Was it a forced exit from Bondora's side, and do you think you could have maybe still kept room for those products for even if it was just a smaller margin, 10-15% of investors that wanted to use the Auto Invest version on Bondora?
So I said, we're trying to design our products and our sort of like product strategy based on our existing customers. And when you end up in a situation that 97% of your customers or 98% of your customers use Go and Grow, then eventually as a business you need to make a decision on how long do you keep other products that all require technically basically the same amount of support, setup and maintenance. How long do you keep them actually like running? And it's kind of a hard decision because I have personally as a product manager created both Portfolio Pro probably in like, when was it, maybe 2013, who knows, like a while ago, and Portfolio Manager was probably in 2015.
Sorry, can I just interrupt 1 second, because you said like, I just want to comment on the 97-98%. That was really towards the end of the road of Portfolio Pro Portfolio Manager. I think at the time when you were revising your logic, it was still in the range of 85-90%. So considering the user base you had at the time,
no, but there was already,
I think it's more substantial than putting only 2% of our investors wanted to use this product.
So at the time when we didn't feel it's fair that it was 85% of the customers, but at that moment of time, because how the rules were set up, and that was like really 4 years ago. So I don't know exactly what the rules were, but how the rules were set up was that the customers inside Portfolio Pro and Portfolio Manager got a much bigger share of the sort of loans that should have been attributed, which meant that there were a lot of kind of, let's say, very large investors there who were taking a much bigger share of the loans that equally smaller investors and sort of like go and grow investors could have taken. So, we have decided already back then that, when we're designing the products and the setups, we want to make sure that kind of like, everyone, with 5 or 25 euros has the ability to come in and invest, right? That they're not sort of like pushed back in some queues because of, larger investors. And, at that moment of time, we decided to start trailing the sort of, or limiting the amount of volume that goes into one or another product based on how many users are behind. And one moment, you can say that, okay, like what was a chicken and what was an egg, right? And, we can probably debate this, and maybe ChatGPT can give you an answer much faster. But in this logic, we see already a continuous decline in those products. We saw that our, bulk of our customers want Go and Grow, with the diversification it provides, the steady returns it provides, and the sort of like liquidity it provides, plus the ability to just like, you put in 5 euros, 25 euros, next month 25, it still works the same way as regardless the amounts being put in. So it was a business decision, right? Personally, I think, these were, for me and the people who actually created those products, more emotional, because, we kind of had to actually, at one moment, what was like now 18 months ago or 12 months ago, we actually said that, okay, like now, we reached a point that it's not feasible anymore to maintain it. But we've, making a decision to make sure that the API, that sort of infrastructure, that transparency infrastructure that kind of like was running underneath these remains open. But we're not gonna maintain those granular products on our own behalf, because it's created also set up that, with 16 years, the user experience had gotten really, really bulky, right? And there's still, quite some work we need to do internally to kind of like, simplify and make sure that all the features there are relevant. Because the fact that, we're even today combining in the same user experience, the experience for Go and Grow customers, and then there's legacy customers who have portfolios but don't invest anymore, and then there's API customers. It kind of like technically made it all quite sort of cumbersome. So we decided, to take those two products off. We have now actively Go and Grow, and we have API. And separately in terms of UI, we need to see then how to best create an experience that the Go and Grow investors plus the legacy investors who have a portfolio still, and API ones, all get the great customer experience.
How much of that decision also came from, let's say, negative experiences from investors that actually with their facilitated investments through those auto-invest portfolios, achieved a negative return? We can see it on the generous statistics. It varies here and there, but let's say 15% of investors, having a negative return on Bondora. So how much was attributed to, let's say, avoid also negative PR or let's say negative reviews in that regard too? to sunset the product, as you called it?
That wasn't really the driver, predominantly because portfolio manager itself were not sources on their own of any negative returns, other than in situations where the customers really defined certain strategies that were not sustainable. However, overall, we've already for the many past years, set up our internal risk management so to make sure that on kind of like even a subset portfolio level, all of the sort of portfolios, make a return. Of course, that means that the portfolios itself need to be at least, n100 loans, right? You can't, have risk diversification of 10. If you look at Go and Grow, there's hundreds of thousands of loans there. So like getting that level of diversification is basically impossible in Portfolio Pro and Portfolio Manager at the time. An API it's kind of doable if you, really invest in everyone. But the main source of the problem when it came to sort of negative returns was actually secondary market trading, right? Because what happened was that, people looked at, things are not going well, or I need the cash, and then they put the loans on sale on secondary market. Given the secondary market, isn't liquid, then, any transactions that were done on super low discounts. So basically what happened was that people locked in, huge losses, and this like 10 or 15% sort of IRR, on an investor level is not what we want to sort of like achieve and see. So, whilst this is not the source and it was not considered, I think, but it was more about the secondary market trading that triggered, losses on those customers. Because, the return on every loan actually comes through holding it, through the life cycle rather than just coming in and then going out. And at the same time on the secondary market, like there's, people who made their like, hundreds of percents of IRR, but basically buying up loans on sale and then just, keeping them. So all in all, the portfolio manager and portfolio, pro were sunset, only because of the low user base compared to other products, right? I understand there was a big fan base behind, and, it was quite emotional to sunset the products because, I think personally or was still as a active product manager, around those things. But any sort of like the review topics, etc., weren't, considered there, but because the kind of ultimate source for these things was trading on the secondary market, and understanding that this trading on the secondary market was actually where people kind of like locked in the losses.
All right, last chapter. Let's now close the circle and get back to the banking license. Now you mentioned like within the next 5 years you want to have or obtain that pan-European banking license. What's the benefit for a company like Bondora to go this way?
Sure, I mean there's two benefits, right? So first benefit is that it allows us to start offering guaranteed deposits. Probably predominantly term deposits, but maybe like those current accounts in the future. But at this stage, we're not thinking about this. And this is a product that our investor base our customer base has already asked us a lot, because I said before, where our customers currently keep their money, a big part of it is in term deposits in banks, right? And 2 years ago, it was earning like 1 to 2% there. Okay, now it went up, but it's coming down again. And even for unless people were super actively like looking for good deals in smaller banks in non-Central European countries, then even during the sort of last 2 years, it was maybe paying 2.5 to 3%. So that's one that we want to be able to offer term deposits to the customer base we've grown over the last 16 years. And then the second aspect is that it allows us to operate across Europe in a more streamlined manner. And what that allows us to do is to have more countries where we lend, and as a result the risk diversification of the portfolio becomes bigger, right? So that there's more and more granularity, not in terms of any more of the individual borrowers, but kind of the geographic and specific macroeconomic risks related to one or another region kind of get balanced out as well. So like ideally, in the end, there's you could kind of take this as this go and grow of Europe, where you can get like super diversified portfolio of loan fractions issued across Central Europe, not Central Europe, but all across European Union. And if you look at all the products available in the world, there's nothing really that gives investors that kind of access, right? So there's maybe a couple of asset-backed securities and securitization products, but these are typically accessible only to institutional investors, and even there, the risk diversification, the geographic diversification is maybe 3-4 different countries. So ideally, in the end, we want to provide a kind of like for investors, one-click investment opportunity, be that for term deposits or go and grow, to have a effectively investment that's backed by loans all across European Union.
I remember conversations in the past, or I think also back then 6 years ago when I came here the first time, or it's a different office, but where you were
across the street.
Yeah, across the street, where Ergo took over now. That back then I think it wasn't a discussion to become a bank or apply for a banking license, as far as I remember. Do you remember when this shift came from going that direction?
I think we've known that this is inevitable from quite early on, but inevitable in the sort of time scales that we're kind of looking at planning at the business. So rather in decades than a few years, because the key people around the business really have a very long-term view about growing the business over the next 50 to 100 years, right? So it's a long-term plan, and we've known this needs to happen at one stage, because regulation is quite uneven still between banks and other institutions. There's a lot of access to information and markets that banks relish. That we see that if you don't go down that path, we saw that we don't go down the path, we will not be competitive. So we knew that part already, a long time ago, that there's some, let's say, not macroeconomic, but regulatory sort of trends that push it. But I think the first time we thought about this was 2016, 17, 18. 2019, we're kind of had it already somewhere in, let's say, a long-term roadmap as just an item. And, it kind of started to grow, from just an item until now, end of 2022, early 2022, we finally took a decision, we start working on this path, right? But initially it was just a kind of one of the projects that our legal team was looking into. What does it need, etc. We hired MD for the CEO for the bank to be now close to 2 years ago, who took over, started to put together the team, to put together the business plans around this. So, and we've started to very actively change the way the company is structured, the people. It will be announced pretty soon where we're standing. We're having we just had a new supervisory board put in place by the shareholders, where there's 3 people who've managed, big banks in the past, who bring in a lot of finance and risk management experience from banks. We brought in terms of overall risk management, we're following the sort of 3 lines of defense, let's say, approach that's standard for financial institutions. How we structure the teams. There's a separation between the people who take decisions, then there's separation between the people who kind of like, provide oversight on those decisions, monitoring and risk governance, and then there's separately internal audit. On top of that, there's like, very professional supervisory board who, looks after it. So there's a lot of governance and risk management work that goes into this. So when you kind of like asked, why are we confident that we're able to deliver what we set out to deliver to Go and Grow investors over the next 10 years, is that we're doing a lot of work to ensure that this will happen, right? And there's a lot of investments in terms of people, talent, and infrastructure that is going into that. But it's quite long, right? Why we're also saying 5 years, it takes a lot of time, right? So it's first you need to kind of like build out the organization, and all the documentations, all the processes, also IT systems more or less, you need to have in place before you actually kind of like, go into the application fully.
And once that point in time will come and you obtain that license, what is the likelihood with all the compliance that you will have to fulfill then? You will also disclose, let's say, what we discussed in the beginning, manage portfolio, performance of your assets. What are the chances, there will be this added layer of transparency that I would say is currently lacking?
So if you think about, as a bank, you would publish anyway every 3 months audited accounts, right? Which cover a lot of your activities. So the entire banking group basically needs to publish a lot of information, but then it comes into a very specific standard form, right? That is defined, to all of the banks and how it's there. How Go and Grow will sit inside of the bank and with the bank is still something we need to figure out. Like, how do they work together? Because the product like Go and Grow is not a typical thing that you would have inside of a bank or inside of a banking group. So we need to still, this is one of the big topics we haven't decided upon, how those two will interact. Can they remain in the same group, or we need to kind of split them up, or what to do? It's still quite open. We've seen different things happen in different parts of the world where this has happened. So I think there's the Radius Bank or Lending Club example, and then the SOPA, and then there's Fellow Finance. So these are all sort of different experiences on the market that we're looking at to find the best way actually how to combine the business we built over the past 16 years and then the business that needs to be a foundation also for the next 50 to 100 years.
All right, sounds good. Yeah, lastly, a private question, if you allow. I know back in the day you said like you're all in Bondora with your personal investments. Is that still the case, or have you added any other assets to your investment portfolio recently?
No, other than the house I live in, then everything I have in terms of my personal wealth is either in shares of Bondora or in Go and Grow.
Okay, so that remained the same. All right, then I think we come to an end. Thank you very much for your time. I mean, just a little last note from my end. In the past years, I've been always like pointing out certain things with Bondora, which, have always had the interest of improving the platform or, pointing out certain elements for investors to be more aware of. And I really appreciate that because we couldn't manage to meet last time, short term, unfortunately, but greatly appreciate that you allowed me to be here today. So we have this conversation and, allow me some more critical questions on the business development and of Bondora, of the company. So much appreciated. Thanks for the invite once again. And all the best of success for your future endeavors and projects.
Thank you. It's great to have you here, and I feel it's good for me to answer those what you call critical questions. I think we have quite strong logic and arguments for that guide us in our decision making, and we're not really afraid to discuss them. Just in a normal, let's say, blog post, website format, it doesn't sort of like work out in a way to put that on a banner, but we're always happy to comment and discuss these topics.
All right, thank you very much, Peter. The obligatory handshake.